Hi, I'm Simeon Wallis, Chief Investment Officer of Aprio Wealth Management, and welcome back to The Pulse, where we take a month-to-month look at what happened in the economy and the capital markets. You make better decisions in your business and with your investments. Let's start with the highlights. Markets are under pressure, but not breaking. First quarter earnings are okay, but it's valuations that are adjusting. And confidence is falling, even as spending holds up. And the real worry isn't a crash, it's stagflation. Now, let's take a deeper look at the data, see what else we could learn. U.S. markets have reacted negatively to the April 2nd tariff announcements, with all U.S. markets down, pushing them into further losses this year. Now, in contrast, international markets are higher year to date. There's been an almost 20 percentage points difference between the NASDAQ and developed international markets. Now, for the month, bonds are down on the expectation of higher inflation from tariffs, though they are higher for the year. And concerns over economic growth and a potential recession are evident in commodities. Oil is down nearly 13% in April, and copper has given back some of its gains year to date. Now, in contrast, Bitcoin has jumped this month, erasing nearly all of its losses for the year. Now, showing up in markets is what many executives that we speak with are feeling. Like we're in this thick fog, and it's hard to see to the other side. And as markets hate uncertainty, we're seeing a shoot first, ask questions later approach from many investors. Now, the good news is that eventually the fog will clear, but we don't know what the world will look like, which leads us to the most important question. If we resolve trading tensions with our major partners such as Japan and the EU, does this event become considered just a temporary blip, or are we experiencing much more of a structural change? Now, it's too early to know the answer, but this is the critical question, and we need to remain aware of this. Now, valuations have come down meaningfully. The Mag 7 and the NASDAQ forward PEs have dropped sharply this year, but they're back just to levels where they were 2 years ago. Broader markets, especially international, continue to sit at much more reasonable valuations. And about a third of S&P 500 companies have reported first quarter earnings, and earnings are holding steady overall. But we are starting to see a shift. Misses are quietly starting to climb. Now, it's not panic-worthy yet, but it is something to watch. And we're seeing softness in 2025 S&P 500 earnings estimates, which are here in orange. And this is accelerated through earnings season as companies have discussed tariffs. For 2026, which is here in purple, things have been much more stable, but it is starting to decline too. Now, even with estimate reductions, EPS estimates still imply an 8% earnings growth in 2025, despite the uncertainty. And this may actually be a risk for the markets looking forward. Now, short-term government bond yields have dropped sharply as recession fears have grown. Markets are now pricing in 1 or 2 more rate cuts than before, possibly even sooner than the Fed expected. And tariffs hit growth and fuel inflation, and that's at the core of stagflation. A 22% effective tariff rate could shave 1.5 points off of GDP and add the same amount to inflation. Now, to start the year, GDP growth expectations were around 2%, maybe 2.2%. They're declining, but if we get that 1.5% headwind, we're looking at marginal economic growth with little room for error. Inflation was thought to be around 2.5% coming into the year. Now economists are at 3%, and we could move to 4% with the tariffs. High-yield spreads have widened sharply or at or slightly above their long-term averages now. Now, the lowest rated bonds, the triple Cs, which are here in orange, they've moved more sharply, and they're pointing to stress in lower quality borrowers. The key takeaway is this: credit markets aren't signaling systemic risk, but they are signaling that if we did have a recession, it would likely be mild. CEO confidence about the economy has taken a sharp hit, dropping to levels we haven't seen since the pandemic. And the message is clear. Uncertainty is starting to shake conviction in C-suites. Now, consumer confidence is falling fast, and it's not just low-income households. Affluent consumers are concerned too, which could lead to weighing on spending ahead. And despite falling sentiment, consumers are still spending, even accelerating into April. And I realize this feels like a mixed message, but it's a reminder. What people actually say and what they actually do don't always move in sync. Now, to sum up everything from today, here are the key takeaways. Markets have pulled back, but they're not pointing towards a crisis. And earnings are okay, but valuations are adjusting to higher perceived risks. And confidence is slipping, especially among CEOs, even though consumer spending is holding up. And the big risk now isn't a crash, it's stagflation. With that, I'm Simeon Wallis, Chief Investment Officer of Aprio Wealth Management, and I'll see you next time with our next edition of The Pulse.